The introduction of a 15% export duty on most steel products, up from zero, and an increase in levies on iron ore and pallets to 45 to 50% propelled a sharp slump in metal stocks on Monday. Shares of Tata Steel, JSW Steel, Jindal Steel, SAIL, and NMDC cracked up to 20% in intraday trade. Analysts have now turned pessimistic, particularly on metal companies, as the recent policy moves are set to undermine their operational performance from here on.
So this is negative because export, if you put a 50% duty, there will be much lesser realization from exports, and a lot of steel companies are doing exports between 10 to 25% of their production. So you see today they already had a problem with high coking coal prices. So margins were shrinking, and in that this lower realization will shrink them further. So it is negative, and stock prices are discounting that. A lot of it will be downgraded, but then stock prices have also gone down. So we need to do some reworking, and then post that we might have to see how much, if there is any upside left or something.
Some brokerages have already initiated rating downgrades on leading steel stocks as the hike in export duties is expected to lead to a sharp correction in domestic steel prices. CLSA, for instance, has reduced domestic steel price estimates by 8 to 10%. On the back of lower steel prices, the brokerage has cut the EBITDA estimate for steel companies by up to 24%. It sees no near-term upside catalyst for the sector other than a stimulus in China. ICICI Securities, meanwhile, has highlighted the policy decision as extremely negative for the steel sector, expecting a broad-based multiple D rating for the industry. It has also lowered the ratings for most metal stocks. The brokerage has broadly assessed a likely 5,000 to 7,000 rupees per ton of impact on EBITDA for integrated steel players, while for unintegrated steel equities like JSW Steel, the impact can be 5,000 rupees per ton. Besides, according to Motilal Oswal, the export duty hikes can impact the valuation of the sector and companies' ability to invest in capacity growth in the long term. On the contrary, the government has reduced excise duties on petrol and diesel by 8 rupees and 6 rupees per litre respectively. Following this, Prabhudas Leeladhar has cut its FY23 EPS estimates for HPCL and BPCL by 56% and 40% respectively, as elevated oil prices remain challenging. According to the brokerage, OMCs' ability to reduce high marketing losses will be contingent on crude price correction, as high inflationary pressure will prevent meaningful retail price hikes despite excise duty cuts. Technical charts suggest shares of BPCL could see a bounce until their new 52-week low remains unbreached. The weekly chart of Hindustan Petroleum Corporation, meanwhile, currently signals a bearish trend. The stock price of Indian Oil Corporation is well placed given its sustenance above the 200-day moving average level. On Tuesday, logistics player Delhivery's market debut will be closely watched, while in the primary market, chemical company Aether Industries' 808 crore rupees IPO will open for subscription. Besides, Adani Ports, Balkrishna Industries, Balrampur Chini, Grasim, IPCA Laboratories, and Metropolis Health will be on investors' watch ahead of their Q4 results. That apart, stock-specific action and global cues will dictate the market trend.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.